Farms.com Market School with expert commodity analyst Mo Agostino is an online educational video series designed to help you, the farmer, improve your knowledge of grain marketing. Farms.com Market School is brought to you by DeKalb Brand Seeds. DeKalb, growing confidence. Today's video is about the short crop long tail years like 2012 and 2013. In this video, we will define the old adage, short crop long tail, and which years qualify and what to expect from prices. Today's topics include the 2012 US Drought, the most recent short year, and long tail, definition of that old adage, short crop long tail, and which years qualify. We're going to look at US corn and soybean balance sheets and what to look for, and when to ring the bell for our top and short crop years. So our first topic today is the 2012 US Drought. Here's an example with a US Drought modern map. And the 2000 US Drought was the warmest in 91 years. If you remember 2012, we started getting very dry at the end of 2011, and it became very hot through March of 2012, and it just continued right through August. And this US Drought monitor map showed the extreme drought that was going on. In fact, it was the worst since 1956, and these are some photos that show you what the US Drought was doing in 2012. Again, another picture of what it was doing to corn yields. And so this is a chart showing you the yields dating back to 1866, and you can see the extreme drop there of about 26%, and the yield going from a trend line average yield of 164 down to about 122. Again, here's that US Drought monitor map as of September 25th, 2012, and it's showing you the extreme drought in the US Midwest. So the 2012 qualifies as a short crop long tail year like 1988. You can see from the chart provided from MRCI.com, you get the big spike in prices. It rations demand, and then when it's over, it adjusts for the upcoming supply the following year, and the price tends to overall drop over time. So our second topic today is the definition of the short crop long tail. Prices, there's three principles to this short crop long tail. First, prices need to move up sharply, as I just mentioned, to ration demand. Corn futures are up 29% in 9 months in 2012. In fact, in 2012, the price of corn went from about, as of July 1st, went from $5.56 all the way up to $8.49. It almost doubled, and it was up about, not double, but up about 54% if I remember. A short crop followed by a larger crop, like in 2012, followed by a larger crop in 2013. Where in 2013 farmers were expected to plant 97.5 million acres, which I believe is a record. Once the peak is in, an extended period of time, declining prices occurs to bring demand back in line with the new production. So here's an example of a chart showing you the short crop years going back to 1970. It's about 40 plus years, and there's been about 11 years, the last one 2012, where the yield has dropped considerably. The last one in 2012 we dropped 26%. Here's an example, a short crop year for beans. Not as many on the beans. Beans are not as susceptible to dry weather, I guess, as the corn. Corn seems to pollinate through July. We tend to get a little bit more dry weather through July, I guess, whereas with beans it's more towards the end of August. There's been about 8 years of last year in 2012. The bean yield, though, didn't drop as much as the corn yield did, about 20%. Our third topic today is reviewing the US corn and soybean balance sheets in short crop long tail years and what to look for. So USDA puts together these balance sheets. They come up with acres, yield, production, and then they apply some demand. They come up with these ending stocks. The key here is you can do the same thing with a spreadsheet. You plug in your own numbers and you make assumptions about the future. You're going to have to do that. So if your assumptions come up with a very tight ending stocks number, this is corn. You start getting down to that 700, 600 million bushels of ending stocks on corn, very, very tight. What's the price going to do? It's going to explode, okay, like it did in 2012. Here's soybean balance sheet again. Do the same math. You come up with 115 million bushels in ending stocks on beans. You know the price is going to take off, and of course, in 2012, the price of beans went to 17 plus per bushel. Our fourth topic today is when to ring the bell for the top in short crop years. So here's an example with the 2012 corn December daily futures chart, and you can see the short crop, the big spike, okay, and look at those moving averages at the bottom. We've covered moving averages in a technical analysis. There's part 1, 2, and 3, but when that purple line is breaking above that red line, the 200, purple's 100, so the 100 crossing above the 200, that's a major bullish signal telling you something is wrong. Market takes a while to factor in that dry weather. Remember, we had dry weather throughout 2012, but it wasn't until, beginning the middle of July that the market started to pay attention, and then all of a sudden it spiked higher. So that's how you make a lot of money in grain marketing. You should have never sold anything after that. Now you also have to anticipate the top, so you can see at the top, market starts to create those double tops, maybe triple tops, rollover effect, moving averages crossing over to the downside. You got to start pulling the trigger, because that's when the short crop, the rationing of demand, has done its job, and the market starts to roll over and prices move lower. Top is usually in by June to August. That's what historically the market shows. September is usually a bad month to sell. Usually that's when harvest starts to occur, and you can see from the different grains, corn, oats, beans, you can see that the price doesn't tend to do too well through September. October, however, is a better opportunity to sell grain. So, try to avoid selling grain through September. By October, the market has some idea of how large that crop is. So by September, we've factored in most of the news. October 1 seems to be the low the last 5 to 7 years. Shortly after that, the market starts to bounce. Why? Because when we drop prices, we start to create demand. So in summary, booking forward your 2013 corn at US $6.50 a bushel when corn in 2012 was $8.49. Okay, you're trying to anticipate a year in advance, is a great opportunity. How often have you sold corn for $6.50 a bushel plus or minus your basis? Selling beans at 14 bucks also makes a lot of sense, or canola at $5.50. Booking up to a maximum of 50% of your guaranteed bushel yield forward a year in advance makes total sense. If that's your first start, it's a great start. At 50%, you're not overbooked and you're not underbooked. You still got a lot. Remember that 50% of a higher yield, potentially bigger production, may only be 30%. You still got 70% of your actual bushels to sell at some point, so you still have a lot of bushels. Leaving your room to sell more at higher prices, Mother Nature again next year does not cooperate. That's why we do that 50%. It's just to manage risk.